Hello and welcome to Westpac London's end of day for Friday the 15th of July. Three key talking points of the day. First up, Westpac Economics changing our rate view for the RBA, now expecting the next move from the RBA to be a cut, not a hike. Second up, we had the European bank stress test just released in the last half an hour, which I'll go through. And thirdly, just a couple of data points out on the US economic calendar to run through. So first up, Westpac Economics causing a little bit of stir in the markets this morning. Changing their rate view. Now we're looking for 100 basis points worth of easing from the RBA over the next 12 months. Now if you recall, our previous view had included one more rate hike from the RBA in Q4 before an extended period of on hold. That was pulled back just a week or so ago, now expecting on hold. So why the big change? Well, we have seen a deterioration in the domestic data over the past month or so. In particular, our very own Westpac Consumer Sentiment Survey, which just came out a couple of days ago, showing a very, very sharp fall in consumer sentiment, down to the lowest levels last seen May 2009, and a very large magnitude of fall and deterioration in some of the components. People very, very worried about losing their jobs. People very, very cautious about how much they want to spend, whether they want to purchase big ticket items. So very much negative sentiment feeding through there into the Aussie consumer. Now we're not calling a recession. We do think that the mining sector will still produce growth over the next year and will support the economy. But if you remember, the RBA have been one of the only major central banks in the developed world to have been able to raise rates over the past 2 years since the GFC. Some of those interest rates now just starting to feel the pressure on the consumer, but that cushion that has been built up is now obviously a good time for the RBA to just use some of that and just ease some of that pain and pressure that we're seeing on the consumer at the moment. So just to reiterate, Q4 is the timing of the first cut that we think, and that's going to be the first of 4 rate cuts of 25 basis points over the next 12 months. In terms of the trigger point for that cut, we actually think that the first cut at the end of this year will be driven by Europe. Still a lot of uncertainty around Europe, very, very much feeding into the negative sentiment around the world at the moment, and we think that's probably going to be what causes the RBA to cut in Q4. And going forward, the consumer still remains slow as we head into 2012, so there'll be some more cuts just to relieve some of the pressure on them. Turning to Europe now, bank stress test results released just in the last half an hour. We got a total of 9 banks which failed the test out of a total of 90. The key figure here though was the total amount of recapitalisation needed to get those banks up to speed. Only estimated at 2.5 billion euros. Very, very much at the low end of expectations there. Whether that's a credible number or not, we'll wait and see. There'll no doubt be a lot of analysis over the weekend with regards to just exactly what's being held on some of those banks' balance sheets. But still, the key thing for me at the moment is the continued ongoing uncertainty around the wider plans for Greece and the EFSF and what the EU plan to do to just provide a bit more of a backstop to prevent this spread of contagion that we've seen over the last week or two. When do we get an answer from them? We're still not sure. There was talk of an EU summit today, didn't materialise. Has been talk again that maybe it'll be on Sunday, could easily be on Monday. We don't know for sure, but just keep an eye out on the weekend and let's just see if we get any headlines out, and hopefully we'll be in a more positive mood on Monday morning. In the US today, a couple of data points just to go through. CPI first up, contracting 0.2% on the month in the headline, just being weighed down there slightly by gasoline prices and the fall that we saw in oil prices over the month. Oil prices I think were down around 10% in June, so just feeding through into the headline there. Core rate though, still trending a little bit higher, up 0.3, just taking that annual rate up to 1.6%. So no real concern about any deflationary threat in the very near term in terms of the US at the moment. Probably a bit more important right now, a bit more forward-looking, Empire Manufacturing Survey, very disappointing, still coming in negative, second month in a row now, coming in just below -3. There was a bit of hope that we'd start to see some of the easing in the supply chain disruptions from Japan coming through and a bit of momentum picking up in the manufacturing sector. Not really seeing that through just yet, so wait and see in terms of the other forward-looking indicators that we get, but at the moment, very disappointing. In terms of numbers then, equity markets, as I said, not a good day still. Euro stocks down another 0.7%. FTSE fared slightly better, only down a couple of points. In the US, S&P and Dow were mixed. Not really much reaction in terms of the bank stress test results. Just before I started recording, the S&P was up 2 points. Dow was marginally negative, just around 2 points as well. In currency space, the Aussie dollar took a little bit of a hit this morning, just on the back of our rate change view. Just selling off down to around 106, but been trading pretty sideways for the most of the session today and settling around 106.50. That's it from me. Have a good weekend, and I shall see you on Monday.